Well, good morning. I'm Bill Montgomery from 1049 The River, and it is just a couple minutes after 11, and looks like many of our folks are going to be here, although I think we'll probably have a couple pop on later. But wanted to first of all just say thank you so much for coming to our webinar this morning. Very excited to just do some things that can help small businesses. Don't need to say anything about 2020. We all know what that has been, and I think we're all trying to do what it takes right now to recover and come out of this. And so we want to do our part as we can to just educate, inform, and help. And so to that end, we are working with Gerber and Randy Gerber specifically. Want to thank you or thank Allison Forshea, who I've had a great business relationship over many of the years. She's been an advertiser on the river with her husband's orthodontics practice, and so we've worked together for many years, and through some work with the Gahanna Chamber, have gotten to know and hear Randy, and he's certainly doing some great things in the community. So we think this is going to be very helpful information. This is one of a three-part webinar. We're doing another one in January and in February. And so we'll get details out to you on that. The last thing I want to say before I turn things over to Randy is just as you have questions at any point today, go ahead and put those in the chat. And we will have a Q&A time at the end. And so, but don't feel like you've got to wait till the end. You're welcome to jot them down and do that. But if you want to put them in the chat, whether you do that privately or do that to the group or do that to Allison, we will make sure that those questions get answered. So again, thank you for joining us this morning, and I'll turn things over to Randy.
Thank you very much. So what, press the button now?
Yeah.
But it's his screen still, I think, right?
This one.
Yeah. Where's the share screen button? Whoops. We're getting there. 1 second. There. But it looks like it's his screen still.
So it'll
switch. Okay. All right. Can everybody see, or Bill, I guess, can you confirm see the better predicting success recap? Okay, good. So first and foremost, I'd like to say thank you to Bill and 1049 for having us do this, and a special thank you to Allison Forshea, who is out there beating the bushes, meeting people, and allowing us to do these type of presentations, and for Andy Scott for helping on the technology piece of it. I'm Randy Gerber, and a quick little just introduction about our firm and me. So we have two businesses, the first of which is Gerber. We work exclusively with first generation entrepreneurs. And there's a long story why we got there, but fundamentally that, our objective is to help our clients grow their business with purpose, understanding the amount of risks they need to take, understanding what the end game looks like, how to improve their cash flow through the growth of the business, which is always tricky, and how to have fun doing it along the way and live the life that you've always envisioned living. The average size client at Gerber is about $45 million of sales. Now that's today. That wasn't the case 15 years ago or 10 years ago, but we've had a lot of success helping people grow their businesses, and with about 40 clients selling their companies for really good exits. The other business we have is the Emerging Entrepreneur Experience. And this is really for companies that are from $300,000 of sales to $1 million of sales that are trying to get to a $3 million level of gross profit, not gross revenue or net profit, but gross profit. And this is a one-year program that's really about sequencing of what to do. So having a written executable business plan, understanding how to finance organic growth, understanding how to create a scalable company and operations, and as well as defining your culture and nurturing that culture, among other things. So those are our two companies. And the reason why I bring that up is that, next year we'll be in business for 30 years, and with the focus on, or exclusive focus on first generation entrepreneurs since about 2007. And it's, being an entrepreneur is a pretty lonely place. And there's not many folks, statistically speaking, who A, have done it, and B, been successful. And so a lot of entrepreneurs just don't know where to go for advice, don't know where to go to help. And one of the big issues when you're an entrepreneur is cash. First and foremost, I will say, and 2020's totally made this point relevant. Cash solves problems. It even makes you a little bit happy in some respects, from the standpoint that by knowing you have your problems solved, there's a little less stress in your life. And the big idea here is that you can and should build cash in most business environments with discipline. And this is probably the one big thing there that I see, that I meet so many first generation entrepreneurs that they say, well, all my money's wrapped up in the business. And it's true, it is, but it certainly doesn't have to be. And so most entrepreneurs are not disciplined in really the creation of cash, and then the discipline of diversifying cash off the business balance sheet to the personal balance sheet. And in short, the short idea behind this is that as the business gets bigger, so you have more infrastructure, more costs, more leases, more contracts, more employees, more expenses, more of everything, you have more and more risk embedded with that. And most entrepreneurs are not disciplined in diversifying that risk with liquidity to their personal balance sheet. And 2020 has really proven that right now, banks aren't lending money into businesses with declining revenues. They're not. In fact, there are banks that may not be lending money at all because of their own personal or their own business situation. However, if you have cash on your personal balance sheet, you have lots and lots and lots of options, and it helps you perform better as an entrepreneur, and it also helps you to finance growth and be opportunistic in difficult times. But it really takes discipline. So today, we're going to talk about basically three things: understanding cash is king, understanding what growth with purpose means to us, and then the process of how you do this. So, 90% of small business failures are caused by poor cash flow. That's from Dun & Bradstreet. And, there's all sorts of statistics out there that you guys have seen. 4 in 5 businesses fail in 5 years. 1 in 10,000 businesses last 10 years. I'm sorry, 4 in 5 businesses fail in 5 years. 1 in 10,000 businesses make it 10 years and do $1 million of sales per year. And so much of this is rooted in cash. And so, the first fundamental idea you have to really understand, and by the way, one of the most under-hired, under-respected roles in companies in Central Ohio is a high-quality controller or high-quality CFO advice. And this is something that has to happen internally in the company. Most folks are accustomed to having a good bookkeeper where they know where the money is and the entrepreneur trusts them, but they're not getting strategic advice how to create cash and how to grow. And again, we don't perform that service for our clients, but we see this over and over and over, that's a shortcoming of businesses, whereas the first place we looked is to help them upgrade their talent, either via training or replacing them or getting outsourced help or a mentor for that person to really understand how to help you as the entrepreneur strategically advise you internally how to create cash. So the first issue is growth. If you're growing your business, it sucks cash. It just does. That, very few companies can have revenue that's increasing and free cash flow increasing at that same rate. So, if you're planning on growing and it's one of those things that at a bare minimum, you either grow or you do die, one of the two, it's going to suck the cash out of your business. Lack of cash sucks energy. It sucks energy out of you as the entrepreneur, sucks energy out of your leadership team. It may suck energy out of your household. And so, this is where you have to really understand where the cash is, how it's being generated. Cash does equal happiness, kind of. I mentioned that earlier. You have to have fanatical cash management. It's a big deal to really understand what's happening, what's going to happen. And I'll tell you, our clients, some of our clients that the pandemic's been unfairly difficult to, it's bad grammar. So some of our clients who've gotten hurt worse than others because of the pandemic, those that manage cash, which that there are, they're doing okay. They're not happy people necessarily because of the environment we're in, but because they have cash, they're able to be opportunistic. They're able to keep their A players on their team. They're able to sleep at night. So, and who predicts pandemics, right? I mean, they happen. And cash doesn't mean you're debt free. And this is one of the things we see. It's a common theme among first generation entrepreneurs that they want to be debt free. They feel that debt is bad. Debt's a really powerful tool if used properly. And having lots of liquidity on your balance sheet and lots of liquidity or lots of cash as well often offsets debt. This is one of these environments we're in right now where use of debt's pretty efficient to get return on your internal investment in your business because you're borrowing at such a low rate. So it's really a balance of understanding the debt, understanding the cash flow, understanding the cash creation, and what that does for the internal return on your business, which here's something that most entrepreneurs really don't understand and don't think about. Assuming you're taking a reasonable wage for your industry, right? And so that's something that we can help you with, or it's available information that based on you, if you were replacing yourself as your function in the business, if you had to go out to the market and pay yourself, what's a reasonable wage for that, right? So businesses, then this is from Simple Numbers. Greg Crabtree is an accountant down in Birmingham, Alabama, and has written lots of material on this topic. And this is primarily for businesses less than $5 million of sales. And probably pretty true for, up to $15 million of sales. But if your pre-tax profit is less than 5%, you're on the verge of going out of business. Okay. So, and this is where things get kooky for folks that, if you're a $10 million business and you're making $500,000 a year, well, by every American standard, paying taxes on $500,000 of income is a lot of money. It is. And you're successful by every standard there is. However, that's not enough pre-tax profit to put your business in a permanent position of strength. It isn't. 10%, it means you have a really good business that you're in pretty good shape. You're able to create liquidity on your personal balance sheet and even in your business balance sheet. And above 15% is a fantastic business. Which is why when you start looking at some of these companies out there that are publicly traded, you start seeing these returns of 15 and 20%. They're outstanding, right? If you're a professional service firm, these numbers really don't apply to you. Well, hopefully they don't apply to you. Professional service firms should have pre-tax net income somewhere in the neighborhood of 25 to 50%. 25% of the low end, 50% is a good number. If you're approaching 60% and your pre-tax net income as a professional service firm, you're probably not investing enough money back in your business to grow it. So, but these are, this is where having an internal strategic partner on your team who understands the day-to-day mechanics of your business from a cash flow perspective, from a return perspective, really helps you, because they're the ones, because you're probably the visionary in your business. You're the one, the relationship person and the product person, and oftentimes your strengths. While you may understand your balance sheet, you may understand your income statement, you really don't necessarily understand the internal workings of how cash is created. So having somebody on your team to help you do that is super critical. So what are some cash gobblers, things that eat up cash, particularly for businesses less than $10 million of sales? And this is even more pronounced for businesses under $1 million of sales. Having bad or no controller. And that's another one, I guess. I said bad controllers. Lots of folks have no controllers. They have no help at all. And so they just have a bookkeeper who's preparing the books to make sure they're accurate. If you have a business that has inventory, we often see that the Inventory management is poor, and so a lot of money sits in inventory in your warehouse. Accounts receivables, this is very regular where a lot of small businesses just they don't have a person that's really managing the account receivables. And all of a sudden, when a pandemic hits and your clients start having problems, all of a sudden you become their bank. And you have to have a good relationship with your customers, a good relationship with their clients to manage the account receivables, because your cash can get stuck here. And unfortunately, in bad times, this cash may become non-collectible. Travel entertainment budgets. This was much more pronounced pre-Trump tax package. Once the the entertainment budget or entertainment deduction was eliminated, we saw this improve quite a bit. And it's kind of interesting, and I'm actually guilty of this myself, which goes to the justifying entrepreneur, that so many people would use their entertainment dollars in a way that wasn't productive. So said differently, people would entertain because they enjoyed it as the entrepreneur. They enjoyed entertaining people, but they weren't really getting a return on investment. And we really, and they just weren't disciplined. And I put myself in that category for a little bit. When the entertainment deduction went away, people really saw that, we weren't getting return on investment on this entertainment, even though it was pre-tax. So that's something that is very well could come back here to jumpstart the economy, entertainment budgets. But I would really ask you to think about, what is that return on investment, the return on dollar for every dollar you're spending? Are you able to take a dollar investment on entertainment and travel, or entertainment particularly, and could you add a nickel or a dime to your personal balance sheet of liquidity? And most people are going to say no when they really think of it that way. Technology spends, people overreach in technology regularly. And it's because, again, small businesses, you're not, unless you're in that business, you're not a technology expert. Cybersecurity, this is a little counterintuitive. It's not so much defending against it, but if you're a victim of it. And so again, so many small businesses just don't have the resources to properly defend themselves against cybersecurity risks, which are far more pronounced in 2020 because of the stay-at-home situation than before. But this is a place where people cash can get sucked up. We were having at least 1 or 2 clients per year getting malware ransoms, and so I don't know we've had any this year so far, but it was a real problem for a while there. Depreciation when you're buying big assets, and basically a justifying entrepreneur. Somebody who thinks they hear it's a tax deduction. I remember one time when I was talking to my mom, who's not an entrepreneur. She was a teacher, and I made some comment about this. We were entertaining some clients at the dinner, and it was expensive. And she said, "Well, it's a write-off, right?" And I'm like, "Well, yeah, but write-offs aren't free. You still have to pay for them, right?" And so some folks, they spend that money on whatever it be, whether buying new vehicles or buying a nicer vehicle for themselves, or we see buying a building all the time as one that, because people think they want to own real estate. It's a whole separate topic I could talk about for an hour, is your operating business versus your real estate businesses. But people justify decisions, and it sucks up cash, and it's unnecessary. So with this, the biggest cash flow, here are all our cash flow mistakes. Unequivocally, if there's one thing that you folks take away from this, it's not doing a 13-week projection. This is the single biggest issue we see over and over with any new client we have come on board. And most folks say, well, we can't project our revenue and expenses out 13 weeks, but you can. And particularly when you start doing it, you'll get better and better and better at doing it. And so the reason why this matters is this helps you understand your cash flow risk coming. And the reason why we say 13 weeks is because oftentimes the beginning of a calendar quarter, you have some unusual bills due that first week of the next calendar quarter. So you always see that. And 100% of our clients that really engage in this process, and it's not complicated. It's, starting cash position, projected cash coming in, fixed expenses, variable expenses, financing activity to create cash or send cash out, ending cash position. It's just that simple. And again, this is something that you're not going to do as the entrepreneur because you know the time, but somebody, again, a person on your team who strategically understands the growth of the company. And again, if you're growing, you're going to have payroll expenses at a minimum or equipment expenses at a minimum to finance. So, it takes people a few weeks to get this right, but 100% of our clients that have this, their businesses perform better. They just do. As mentioned earlier, not managing inventory properly, not managing, the next two go hand in hand, not managing your line of credit properly and not communicating with your bank. So many, your line of credit should be used to finance the growth of your business. That's it. So many people use their line of credit to finance, equipment or CapEx, capital expenditures. And that's really not what it's intended to do. That should be a term loan. So, you really want to be super disciplined in using your line of credit strictly for financing the growth of your business internally. Not communicating with your bank. And people are oftentimes afraid of their bank and they shouldn't be. But, if you can have a good relationship with your bank, which I know that takes two, and banks always aren't great at making or having good relationships back. But if you can do that, they'll help you more. I mean, banks want you to win. They don't want to be in your business. They want you to borrow more and have more deposits. And so but you have to communicate with them to understand what they can and can't do. Not getting on the same page with your spouse. It's a biggie for entrepreneurs and particularly small businesses. Oftentimes your cash is competitive for what's needed in your business, what's needed at home. And so making sure that your spouse understands your cash needs, particularly if they're unusual in the business, can help them understand what the implications at home. Not aligning your leadership team's compensation. This is a really big one too, that if you think about this is probably the root issue of growth with purpose here, is that if once we understand your life goals and what you're trying to accomplish and how you want to live your life, we know what that costs. We know what that's going to cost you per month and $20 or per year, right? You're going to spend whatever, $20,000 a month, $15,000 a month, $30,000 a month to maintain this lifestyle that you want to have. Once you understand that, then you can understand what your business needs to look like. What does it have to, how much cash flow does it need to spin off in the near term to support your current spend? And what kind of enterprise value do you need in the future to have a liquidity event or an internal transfer of some sort to allow you to get the lifestyle that you want? And so when you understand that, so many times, so many businesses are paying their leadership team arbitrarily. It's either based on some industry standard or, what it took to recruit them over, but it's not aligned with, if you're a $5 million business doing 15% net, you need to be a $20 million business doing 18% net. Well, that's how you should pay your people, is to get them, over 10 years or whatever the case may be. And so many folks don't do that. It's very arbitrary how they pay their leadership team towards where they're trying to go. And most entrepreneurs don't understand where they're trying to go as part of the problem. Understand or confusing profit for cash. So people oftentimes look at their P&Ls and their profit and loss statements and say, we're profitable, but where's the cash? Because they got stuck in these cash gobblers. Managing cash flow with hope. I hope the bank comes in with that loan. I hope that client signs up. I hope that that prospect, signs up and pays that deposit today. I hope we receive the AR. I hope the payable doesn't come in. Happens all the time. And this is where a 13-week cash flow projection really helps you in every single way. And you will sleep at night better when you do this. Thinking a bigger line of credit will solve problems. Unfortunately, if that's what you think, you're using your line of credit the wrong way. And this is, lines of credits are there for growth. Thinking a new client will solve problems. And then lastly, not managing your AR or your AP properly, your account receivable and account payable. So many times we see entrepreneurs where they pay their bills immediately versus paying them on 30-day terms or 60-day terms, yet they're giving their clients 90-day terms, and there's just a cash flow crunch there. And again, it's not having the internal person giving you the strategic advice that you need. So foundational practices, so the inverse of all this is have a 13-week cash flow forecast, train your people and track the activity, manage your receivables and payables, align your compensation with goals. We'll talk about Power of One in a few minutes. For those of you that have inventory, manage that extremely well. This again comes back down to your internal financial person, controller or CFO, really helping you understand your inventory and how it impacts cash. Managing vendor relationships, in difficult periods, vendors can provide financing to you. And I don't mean literally loaning you money, but rather giving you terms. And the only way that happens is if you have a great relationship with them. So you really have to work hard to have great relationships with your vendors. Maintain a proper line of credit. And lastly, and we're not going to spend much time on this today, but is really, can you develop a recurring revenue model in your business? And, we have yet to see an industry that really can't do that. It's hard sometimes and counterintuitive, but it is something that if you can somehow have an aspect of your business or a subsidiary of your business be focused on recurring revenue, it helps with the cash flow volatility. So the starting points track everything. And this is where getting into, and we'll talk more in a second about key performance indicators. But, as an example, one of the things that restaurateurs for years, and again, 2020 has really exacerbated this, but restaurateurs were able to track, they know their year-over-year performance per day. Good ones do, at least. And what the weather can do that, so the nicer the day, the better the business, pretty much. And so if you're ahead of that, you can staff properly to reflect that. And so, try to marry financial data with non-financial data and looking for key performance indicators. In the beginning, this is a new concept to you. Track everything and look for different patterns. Eventually, and we'll talk about this in a few minutes here, you will, the key performance indicators become more and more obvious to you. So as an example, we have a client down in Florida who has a law firm that focuses strictly on traffic accidents. That's it. And they're a very, very large law firm. And they know that the lower the price per gallon of gasoline, the more traffic accidents they have because there's more people driving. Just that simple. So it's obvious when I say this to you, right? But not obvious had I not. So it's something that, they really can, they can tie their marketing to the price per gallon of gas. As Tesla and as EV vehicles get more and more pronounced, we're kind of curious how that transitions, but it's very predictable for them to see how they can market. Understand, as I mentioned earlier, that there's embedded conflicts in your business, that there's competition for capital, competition for cash, competition for financing. I mean, when you go to buy your new big home and get a bigger mortgage, that does impact your line of credit at work. If you try to get a bigger line of credit. So you really have to think through, what are the needs at home? What are the needs at work? What are capital expenditures? What are operating expenditures? And it's tricky. It's hard, particularly when you're growing a business and your family is growing. And I don't mean necessarily having more children, but rather going through life. I can speak firsthand that my kids are 19, 17, and 15, and they're far more expensive today than when they were 9, 7, and 5. And so, there's just more competition for cash and more competition for uncertainty with kids that age, that sometimes you need cash. So this is where being honest with yourself and getting your spouse on the same page helps you in your 13-week cash flow forecast. And we do have some clients who take that 13-week cash flow forecast and have one spreadsheet with their business and their personal consumption on it, so they can really see how things relate to each other. So this is an actual client of ours. The business is not named Rudy's Hubcaps, but it's financials from a client a few years ago. And it's a simple concept, but an important one. And it really transcends no matter what size business you have. So in this case, This company had EBITDA of 3.2 million bucks. And the idea behind this is if you make a 1% improvement in your cost of goods sold, 1% improvement in your price, raise your prices, have 1% volume increase, 1% overhead reduction, change your receivables by a day, your inventory 1 day, and AP 1 day. In this case, the impact was $444,000 improved EBITDA and $515,000 improved cash flow. And for those of you who are kind of saying, well, 3.2 million is a lot of money, drop a zero. It's just that simple. You have $320,000 of EBITDA, is $44,000 of improved profit, and $51,000 of cash flow. And when you start thinking about that as it relates to your business, you know, in this case, you know, $440,000 that's a lot of free cash flow to either hire better people or more people or whatever the case may be. But this is, again, it's a simple concept that somebody on your team really has to be strategically managing, because it doesn't happen overnight. So many of our clients, you know, they don't like to raise their prices. Yet, you know, when you go to the grocery store, the prices go up all the time, you know, and you go to buy new clothes, prices go up all the time. But because of the unique nature of a first generation entrepreneur, they don't do it. And so, and obviously there are some businesses that there is no room to change your cost of goods sold, but you can increase your prices by 2%, you know, or have a 2% volume increase. And this is having a systemic person, or I'm sorry, a person on your team systemically managing this and communicating this and holding others accountable. So, and this again flows back into your 13-week cash flow forecast. So when I talk to people, oftentimes, you know, they talk about, I say, do you have key performance indicators? And the answer is, well, sure. And what are they? Well, we have our profit and loss statements, our balance sheet. Nobody looks at their cash flow statement, even though it's the most important statement of all. But what they're not thinking about is that these are all lagging indicators. These are all things that, you know, what happened. So, you know, versus a leading indicator, which is what's going to happen, right? And for businesses, again, for, you know, this size company, the 13-week cash flow forecast is one of the most important, that identification of certain KPIs. So as an example, and, you know, this is, I should listen to my own advice here, but, you know, when somebody goes on, somebody's goal is to lose weight, a lagging indicator is weighing yourself every day, how much you weigh. A leading indicator, however, is how many calories you consume per day, right? That if you know you're consuming 2,000 calories a day, you're going to lose weight, assuming you're working out. And so many businesses, because this is what the accounting establishment and the financial service establishment and the banking establishment have conditioned you to think that your financial statements, your balance sheet, statement of cash flow are okay, but they're not, because it's all what happened. And, you know, the belief is that these people, I mean, number one, you pay taxes on what happened. For whatever reason, banks often lend on what happened, but what you care about as an entrepreneur is what's going to happen. And this is where, you know, getting into looking for key performance indicators that are predictive in nature for you. So here's some examples. And again, as I said earlier, you want to try to marry some of your non-financial information with financial information. Probably the best one of all, and we've used it for many years. I mean, we've used it for probably 13 or 14 years, is a net promoter score. And for those of you that don't know what that is, I would strongly encourage you to at least read the Cliff Notes of a book called The Ultimate Question. And it's a hard read, Frank. The Cliff Notes are fine. The book itself is very technical, in my opinion. The Net Promoter Score is a question that over time, and Bain Consulting came up with this, that is a one predictive question you can ask your customers to predict the quality of future profits. So the way it works, it's a one or two question. The first question is, on a scale of 1 to 10, how likely are you to refer your family or your best friend, as an example, to use this product or service? If they score a 9 or a 10, that person's a promoter. If they score 7 or 8, they're neutral. If they score 6 or under, they're a detractor. And the issue is that promoters will promote your business to others. Detractors will detract. And we all know this, right? That, when people are unhappy with the service, they're very vocal. So the way you get your scores, you take your percentage of people who answered the question, a 9 or 10, and you subtract from that number the detractors, percentage-wise. If your score is above 50%, then that's a predictor of future good profits. If your score is below 50%, you may have profits, but they're not high quality profits. So, one industry that's notorious for bad scores is the airline industry. Now, Southwest, however, always is in the 60s, but all the other legacy carriers are usually under 50, and at times have been negative, where people, they have no choice. They get on American or United to go where they want to go, and they have a miserable experience, and they tell everybody about it. So, this is something that if you in your business can figure out how to use this and use it consistently, it's a great predictor. And because here's the thing, if somebody scores a 6 or under, there's a second question that comes up and says, may we ask you why you scored that score? That's it. And so if they say yes, they tell you why, and it gives you the opportunity to remedy the problem. And that person many times becomes a promoter, right? And so in Enterprise Rent a Car went through this years ago, where they had the same problems over and over and over again. It was the cleanliness of the cars. And so rather than ask 100 questions, they asked one question, and they got the same response time and time again. Cars weren't clean. So now they're the cleanest cars out there. So anyway, these are things to think about in your business and by the way, employee satisfaction is another one too, that we see that if your employees are happy working for you, they're probably serving your customers pretty well. And then your customers are happy too. So, but anyway, these are some non-financial, financial, to look at some KPIs, develop KPIs. Process for financial reporting. And this is important. This is something we see so often. People just don't have a regular systemic process where they're looking and they're measuring and they're monitoring what's happening. So a weekly basis or daily basis, depending upon your business, looking at your AR and AP, your payroll, 13-week cash flow, and certain KPIs. The monthly, you should look at your financial statements, what happened, and and you should look at compare that on a year-over-year basis, or a rolling 12-month basis. And our best clients are doing it on a daily basis, where they can understand day to day how they're performing, and so they look for trends and look for other KPIs because of that. I personally like quarterly better. Look at the same things, but don't make strategic decisions on a monthly basis. I think quarterly, you can start identifying certain trends. You can look for strategic issues to address and make pivots as you see things change. And this is, again, where, price changes or volume changes can come in, as long as you have the team, push in the same direction. Then annually really is, how'd you do compared to your goal? And this is just a big deal, right? Reconcile to your business plan what happened. And this is another topic, another day, but just the whole idea of having a written business plan that's predictive in nature where you're going is so critical to understand, what did we do right? What did we do wrong? What was the assumption we made that we missed on? And it helps you then, be a better predictor of what's going to happen and better strategically in your business. And that's, I guess, think of it this way. This process takes tactical experiences day to day to allow you to develop information and experiences to be strategic in your business. And that's one of the things that so many small businesses simply lack strategy. They do. And it's tricky and it's hard and it's not simple. But I think that if you're disciplined in this process, you can be more strategic in your business and therefore oftentimes more opportunistic to perform better than your competitors and your peers. So, and with all this specifically, what you're trying to do is create cash to move cash from your business balance sheet to your personal balance sheet. and let me kind of end on this thought for you that's important to think about, that when you go back and you look at the 2008 crisis that we had, it was a debt crisis that businesses and individuals had way too much debt. And as a result, one of the things that happened is that, the Federal Reserve and therefore the banks reduced interest rates. So it gave individuals and businesses an opportunity to refinance their debt to lower rates, either accelerate the term of payment or reduce their payment. And so what happened is over the, next 10 years that businesses and individuals were in far better shape, right? Particularly small businesses. And in fact, going into this pandemic, small businesses were in good shape from a debt perspective. Then all of a sudden the pandemic hit. And what did it expose? Well, it exposed that small businesses and individuals, but we're going to talk about small businesses, had no cash. And, back in April, I was like, well, how is this possible? How is it, we had this 10-year macroeconomic expansion. How in the world could these small businesses have no cash? And the answer became obvious that so many companies, because things were so good so long, were just chasing revenue. And they weren't chasing, they cared about revenue. And so as their revenue grew, their expense infrastructure went with it. And the moral of the story is that some revenue they had was bad. Companies weren't disciplined in only taking high quality revenue. Said differently, that for every dollar of revenue that you generated, you should add a nickel or a penny or a dime of liquidity, at least on your business balance sheet, but preferably on your personal balance sheet. And so the best analogy here, a restaurateur, is that so the pandemic hit, restaurants got shut down. And so for those restaurants that decided to stay open and do carry out, did they offer the full menu? No, they didn't. They offered the best selling, most profitable items. And so I'd ask, like, well, hold on, why did you ever, have the Polish sausage on the menu? And the answer was, well, Mr. Montgomery came in every Friday with his family, and he loved the Polish sausage, and we always served it to him, even though we lost money every time he bought it. And so many businesses did this. So they had bad revenue. And so, one of the things that when you have a process like this, you have an internal person who is managing the process, you got to think that you got to be very focused on the quality of your revenue to allow you to add liquidity to your personal balance sheet. It's not a complicated concept. Very few companies do it, but it's so critical. Okay, so we're the final phase here. We have 2 more sessions. I'm super excited to have 2 of our clients actually joining us. Becca Apfelstadt, co-founder and CEO of Treetree, and Megan Shroy is founder and president of Approach Marketing. On the 26th of January, we're going to talk about building your brand and your business, and which again, for this, I think having these 2 super experienced and great experts in their respective industries is great for small businesses to hear how to build your brand and your business, particularly during these evolving times. And then on the 10th of February, how to build a company culture. And this is, this is tricky. Was tricky. 2020 made it really tricky, where lots of folks had different reactions to the pandemic. Some people blew it off. Some people thought it was the end of the world. And it was very difficult for small businesses to pivot through this whole thing. And so I think for lots of companies, there's a culture reset. And it's not a restart necessarily, but certainly a reset. So those are 2 more sessions. And then lastly, if you want to get a hold of us, here are all of our contact information. Once again, I want to thank you for listening in today. I think we've got some time for questions, and also want to thank 1049 The River and Bill Montgomery for having us as well. So are there any questions?
Randy, I saw one question earlier when you were talking about the Net Promoter Score. Can you name what book that was again?
Sure. It's called The Ultimate Question. Again, it's not a really enjoyable read. But I will tell you the reason why I suggest you read it is so many companies try to modify the process. And one of the things that I've seen for myself and for our clients, stick to the process exactly as written in the book. It's the most reliable information and it's not complicated. So I think it's fine to get feedback from prospective customers and customers other ways. But when you're doing the Net Promoter Score, I really encourage you to do that independently in a vacuum.
Yeah, quick testimonial to that. We did that a couple of years back here at the river. And again, if you've got those 9s and 10s, those are your passion people. And that's so critical to have those, because if you don't have people passionate about you, they will happily choose somebody else to do business with when given that choice.
Right. What other questions do we have? All right. I'll check my chat here to make sure there's nothing else in here. Try to check it, but it's not letting me check it. Yeah. I think that's it. Yep. All right. Well, thank you very much for joining us today, and feel free to reach out if any additional questions, and enjoy the rest of the week, and happy Thanksgiving, everybody.
Thanks, Randy. Thanks, everyone. Have a wonderful weekend and enjoy your Thanksgiving.
Thanks. You too.